What's going on, everybody? So I just did a couple of videos. I did one on ET, energy transfer, and I did one on CVS. I didn't realize, I knew CVS had a lot of revenue, but I didn't realize they have like the, I think 12th largest, they generate, if you rank every company in the world, not just in the US, every company in the world by how much revenue they generate, they rank 12th in the entire world. Revenue by company. That's pretty significant, right? Let's see. We all know Walmart is number one. Sheesh, okay, this is more updated than the chart I was looking at before. So Walmart generates more revenue than any company in the world. Amazon is number two. So you might be saying, how come Walmart is smaller than Amazon? Walmart is half a trillion. I love AT too. Hey, DRG. Walmart has half a trillion market cap, but Amazon has 1.2 trillion. So they're 5x the size. Well, you probably know, but I'll say it anyway. Like, why is Walmart? So let's get the actual numbers. 408 billion. Let's do it by trillions. So they're half a trillion. And let's open up Amazon. Amazon is let's just call it 2 trillion. It rounds to 2. So it's 4 times the size. But Walmart has more revenue. So how could that be, right? Why isn't Walmart bigger than Amazon, let alone a lot smaller? So they had 648 billion. And then Amazon had did you ever look up the Millennium Fund and Renaissance Hedge Fund? Their founder just passed, Jim Simmons. No, but I think I remember you talking about that. 591 billion. So something doesn't seem right, because Walmart has more revenue. Well, revenue is just one thing. Even though it's important, it's a really important metric. The most important metric is probably cash flow. I mean, net income too, but net income can be a little kind of skewed depending on the company. So if you looked at cash flow, and let's just focus on, let's look at both operating. So this is Walmart, 36 billion, 15 billion. Operating cash flow, free cash flow. Walmart not growing like Amazon. Yeah, that's part of it. They're not growing like Amazon, but why if their growth plateaued, why aren't they already the same size, 2 trillion? Because usually a company grows, growing meaning market cap, the market cap goes up well before they hit their numbers. because it's just not a profitable business. Walmart. And the ironic thing is they do the same thing, right? Amazon just took Walmart's model and put it online. They just sell everything. Amazon. Yeah, because the most important thing is profits or cash flow. So when you look at their revenue, it doesn't seem to make sense because you're like, oh wait, Walmart has more revenue than Amazon, so you should buy Walmart stock, right? Because it's so undervalued. But when you look at it's almost 3x operating cash flow and free cash flow. Amazon is almost 3x. So Amazon, it still seems like not a good value relative to Walmart because Amazon is only triple the free cash flow and they're quadruple the market cap. So either Walmart should be going up their market cap or Amazon should be coming down. But I think as Blade eloquently put it, they're growing. And why is Amazon so profitable on so much less revenue? You guys probably know why is Walmart so profitable? Because they pretty much do the same thing, albeit Walmart has brick and mortar. I wasn't even planning on talking about this. I don't know how I got on this tangent, but Walmart's brick and mortar. Of course they sell online. Everybody sells online, but the true business model of Walmart is the stores. That's how they started, and that's probably 80% of their business. Amazon is, online. So Amazon has the edge there because they don't have to. They don't need as much kind of infrastructure. They don't need to build all these retail locations. They do need distribution centers, of course, to carry the products and logistics centers, but they don't need to staff a building with so many employees. Walmart has larger capex. Maybe. I don't know. Let's see. Amazon, 53 billion capex. Actually, no, I don't think so. $53 billion. Walmart, 20 billion, 21 billion. So it's actually pretty lopsided. Amazon is much more capex spend. Because Amazon doesn't really make that much from their e-commerce business. It's not an amazing business model. It's not that great of a business model, which it kind of sounds odd because they became such a massive company on this business model. But it's a good business model. It's a much better business model to sell billions and billions of products online than billions of products in a brick and mortar store. It's much more profitable, but it's still not that. It's not like a Google where they just sell ad space. That's a great business. That's really profitable. I'm surprised no one said it. I mean, the main reason Amazon is so much more valuable is because where does half their cash flow, half their profits come from? It's a segment of Amazon that's only probably 10% of their revenue, but half their profits and cash flow come from this one segment. And that's why they're such a valuable company. And it's not AI because nobody makes money from AI except NVIDIA, right? Maybe in the future. It's cloud. The cloud computing market, they control almost 40% of cloud computing, which is how pretty much websites run. And half their profits are from their cloud business because it's such a profitable business. Because if Amazon was just an e-commerce company, they would be like eBay. They would probably be valued similar to eBay. E-commerce business is not like, it's not $1 trillion business. You can't make $1 trillion from buying and selling physical goods. It's just a tough racket. Let's see. This is a good way to kind of like look at companies and compare them, because it kind of, big picture, Tidewater, Loka Buddha, 26 billion, 10 billion of revenue. Let's see the operating cash flow, 2.2. Free cash flow, 1.7. Let's see, I'm just getting actual numbers so I could do calculations. So, okay, so here's the Amazon's market cap is 77 times eBay's market cap. Let's see, Amazon's revenue. Okay, this is a good picture. This is how you can compare them. So free cash flow, we would all agree free cash flow is probably the most important thing with a company. Amazon's free cash flow is 27x, 27 times eBay's free cash flow. Yet their market cap is 77 times. You would think they would be equal, right? Like of course, a company with $1 billion of revenue is going to have more cash than a company with $1 million of revenue. That's obvious, but you want to compare them. You want to weight them equally. This is how you do it. Why is Amazon so much more overvalued than eBay? If they do, theoretically, they do the same thing. They're an e-commerce company. Walmart was an early adopter of computer technology. They had one of the video conferences ever. It's just like, because eBay is just an e-commerce company. They sell things on their website and they make a fee. They charge people who list items, they charge them a fee, and people who buy items may have to pay fees as well. So they just collect fees. So Amazon does that too, but they have so much more. They have cloud, which is the future of Amazon. They also have AI. They have a lot of things. So it's just a better business model with better potential. That's why it's trading. It's 77x the size of eBay, and their free cash flow is only 27 times the size because of the future. That's what we look at when we invest: the future, not the past, or not what they're currently doing. But we got on a tangent. Okay, so Walmart, the largest employer in the world, the biggest revenue generating company in the world. Amazon number 2. Saudi Aramco used to be number 1. They're the 3rd largest revenue generating company in the world. And they just recently went public, Saudi Aramco. They were private for many years, but they do now trade on the Saudi Arabian stock exchange. But not the whole company. I think 10% of the company trades. Sinopec, the Chinese energy company, China Petroleum and Chemical Corporation, PetroChina. China is such a big country, so they have, of course, they're going to be up there. Berkshire is 6th largest revenue generating company in the world, but they don't even generate any revenue. They have no business. They don't actually make anything. They just own companies that make things. So it's the companies they own are the revenue they're referring to, because as a company, they're just a holding company. They hold other companies. Apple, United Healthcare, and here CVS. So 2, 4, 6. So the 9th largest revenue generating company in the world is CVS, which is amazing. I didn't realize it was so high. United Healthcare, which is in the same industry as CVS. United Healthcare is strictly insurance. CVS, they're partly insurance, but I think most of their revenue is from retail. They own Aetna. CVS owns Aetna. I think it was in 2018, they acquired Aetna. Aetna is a really big insurance company. So that's probably like a quarter of their revenue and profits come from Aetna. But I'm just throwing that out there. We'll look at their financials a little bit, and probably 3/4 are from their pharmacies, their retail locations. That's why it's hard to compare, because, and then you have a lot of oil and gas companies, Exxon, Shell, Google's here. CVS. Did you guys ever see that movie, Private Parts, the Howard Stern movie? I always say like CVS. It was CBS in a movie, but he kept like making fun of it, like, because he had to say CVS at least 10 times an hour on his radio talk show. So he would always kind of like joke about it and mock it. So healthcare plans, that's their industry, healthcare plans. So if you look at all the companies in the industry, healthcare plans, you'll see CVS. And you might think, why are they in healthcare plans? Why aren't they like a retailer? Because they own Aetna, which is part of their. So it is hard to compare companies. United Healthcare is strictly insurance. I think most of these companies are strictly insurance, except CVS. They do insurance and retail. Walmart was an early. Okay. So looking at my portfolio right now, up 400%. 400%? Wow. See that? I'm glad somebody's finally 100% on Amazon. I own Amazon. I sold my Palantir. I guess that was a bad investment, Palantir. I mean, bad move on my part. I sold it But you make mistakes. You have vids for them. Thank you. Yeah, I own a lot of Meta, as you know, a good amount of Amazon, and I'm still bag holding Upsellera. 2 years since your analysis on Builders First, BLDR. Yeah, Builders First. Wow. Yeah, they've done really well. Sheesh. I hope I picked them right. Let's see what I. It's tough to these 50 baggers. Like it's hard to really predict a 50. I was in the right ballpark. Okay. See, I had them undervalued. They were 44 in 2021. I had them at 67. So they've obviously crushed. When did I do the video? June 2021, 44 to 67. Well, when I do a video, and I said this in the videos, it's about a 1 year prediction. So if somebody watches my video, like they saw my Starbucks video, and then Starbucks went down because of bad earnings, it went down like 15%, and a person's like, well, you totally missed this one. I can't predict next week's stock prices. Nobody can, but I say give it a year. If I am right, it's more likely it's going to be in a year and not like in a week. So actually, I said 67 June 2021. So let's see June 2022. Well, right after it took 14 months to hit my price. Actually, it did hit 67 after 5 months. 5 months after the video, hit 67. Yeah, technical difficulties. Okay. Usually I have to leave the studio and go back in to refresh things. Now, somebody mentioned Builders First. In June 2021, I did a video on Builders First. They were $44 a share. My prediction was 67. So in June, I did the video when it was 44. It did hit my 67 in 5 months. It took 5 months. But when I do a video, I don't know if you guys heard this before. Like I did the Starbucks video like last month, and they had bad earnings. So the stock went down like 10%. So somebody said, "Oh, you totally messed up this prediction." Like I can't predict next week's stock prices, but in the long term, I'd say give it close to a year, my valuation, because it takes time for things to change. There could be a lot of market kind of disruptions. There could be like just the market comes down as a whole because of something that happened externally, like the interest rates or stuff like that. What studio are you using? StreamYard. I'm using StreamYard. It's pretty good. I haven't had many problems with it. It seems to work well. It's like $20 a month, I think, which is okay, I guess. I think I think all my expenses on this channel, I make about $2-3 an hour. For if I broke down like how many hours I spent and my profit, like my income from YouTube, and computer I could get. So I think that's about 2 years of YouTube revenue right there. Just my computer. So if I look at how much money I spent historically, I'm probably down because I wasted a lot of money on a lot of these people who said, "Oh, we can get you more subs, more views. Let us do your SEO. Let us do your thumbnails." And I never got anything out of that. It never resulted in much. It seemed like just a waste of money. Let's see. Toyota. Here's Microsoft. Okay. Thoughts on Jabil. Is it Jabil or Jabil? I remember doing a video on that company. I don't know. I got to look at that again. I'm not too sure. So yeah, I did a video on ET. I did buy ET in January 2022. Let me see my cost basis. $864. So that's my cost basis. You shouldn't just look at stock price. So you all got your new gas drilling licenses. $15.94. So it's been a little over 2 years, right? So that's my profit. Okay. Profit. Okay. Percent profit. That's pretty good. 84% in 2 years. You did make a video about Select Quote 2 years ago. Now it seems to move from crazy sell. Select Quote. Yeah. You should look at dividends too, because that's part of your profit, your cost basis. Because you can't just look at stock price movements. Oh, come on, why does this take so long? The hell? What's going on? Why does it doesn't work? Okay, finally. Holy cow. Okay. Okay. Sheesh. Okay. So my dividends I received. This is per share. So I'm just doing as if I own one share, but I own more than one share. So it was January 2022. I probably didn't get the February. I don't think I would have gotten a February. Maybe I would have gotten February dividend. I never really do this, like calculate my return using dividends, but it's a good exercise to just see your real returns. So that's dividends. So I actually profited $10.04 if you include dividends. So my return is 116%. What's my return just in the dividends? So I paid $8.64 for this stock. I bought a lot of shares, but this is per share. I paid $8.64. That was my cost base in January 2022. Since that time period, I received $2.74 in dividends because I received all these dividends. So that's real. That's a real return. So I received already 32% return because I got that cash. Even though the stock price went up 84%, I didn't sell the stock, so I didn't realize that gain yet. So right now I got 32% back already. If I wanted to sell the stock, I could and capture another 84%. So my kind of unrealized gain is 116%. That's how much I'm up on ET. That's like this guy. What was it? Starbucks? Yeah, Starbucks. He was like, "Oh, I'm only up like 50% in 10 years, so not such a great return." And I'm like, "Well, you're up like 200% in 10 years, not 50%." And of course, he has to mock me. He goes, "Oh, I guess you're the expert." And I go, "No, well, you got to look at your dividends. You receive dividends for 10 years. You can't just ignore that." And then, of course, dividends could compound too, but I'm not compounding the dividends. In theory, I could invest all these dividends back into ET, which would compound it even more, because then the dividends, the money I receive in dividends, if I buy the stock and the stock goes up, then my dividends grow even more than 32% because the compounding effect. But I'm not taking that into account. So yeah, so I came up with 21 as the stock price for ET. It actually should be higher. It should be 26. But I kind of suppress the stock price because I want to try to predict the stock price within the next year. So I kind of lower the terminal value because some stocks may seem extremely undervalued, extremely overvalued. So sometimes I have to change the model a little bit to try to reflect reality. Yeah, so ET, here's the all the midstream companies, publicly traded midstream companies. So there's 48 midstream companies. ET is the third largest, but they have the most revenue by far, 79 billion of revenue, which is actually almost identical to the first and second combined, the top two companies combined. So if you're a Canadian, this is your baby right here, Enbridge. But like we looked at with Amazon earlier, revenue is not the only stat you need to look at. Revenue is really, really important, but more important is cash flow. And they have less cash flow than Enbridge, but not much less. It's pretty similar, right? But Enbridge is 50% larger. So that does indicate ET is a good value. That's why I'm collecting so much in dividends, because they generate a lot of cash flow and they're undervalued. So they pay an 8% dividend. So, I mean, even if you think 8% is not sustainable, I've already captured 2 years of dividends. So if I keep getting, and the reason and they acquire a lot of companies, but look at my yield. Right, their current yield is 8%, but I've already had 32% of dividend gains in 2 years. So that's like 16% a year. So how could my dividend yield be so much higher than? Hey Victor, what's up? I look forward, everybody. I'm gonna do a live stream on Victor's channel, so you guys gotta try to watch that. That should be fun. So what's the reason? How come? I mean, someone has to know this. Okay, here's the stock price. That's the current stock price, right? Did I get it right? It's 7.87%. .87%. But my dividend yield is 16%. Actually, no. Let me calculate. If you buy ET today, you get paid a 7.87% dividend. But I get a 15% dividend. I'm special. Do you know why? Why do I get 15% and everybody else gets 8%? What trick did I do? How do I get such a higher yield than the market's paying? See, 7.97%. It's the same reason like Buffett has like a yield of like 100% on Coca-Cola, or probably more, 200%. Yeah, exactly. Which I wrote here. Yeah, my cost basis. So I bought it for $8.64. But everybody gets the same dividend payment. We all get, like they just announced last week when they released their first quarter results. They said, okay, we're going to pay 32 cents a share. So everybody gets 32 cents a share, whether they paid $1 for the stock or they paid $30 for the stock. Everybody gets that 32 cents if you own one unit, one share. Yeah, it's just my cost basis. But I could have. It's also possible I could have bought. I could have paid $34 a share. So it's also possible I could have paid $34 a share when it peaked in 2015. That was like the peak of oil prices, and then the oil crash in 2015, 2016. So if I would have bought it at the peak, my yield would be 3.75%. Or if I bought it when it crashed, one of the several crashes, my yield could be 25%, which is a great yield, right? 25%. So it's not that I bought and held, which I did, but I got it at a good price. Not the best price, but a good enough price. That's why, what's a good stock that's been around a long time? Who pays a good dividend? Apple. They don't pay a massive dividend, but it's kind of low. How much is Coke's dividend? Okay, Coke is 3%. You mean let's do Johnson & Johnson. That's a good one. $1.19. That's nice. Okay, $1.19 times 4. So you always multiply by 4 because it's quarterly dividends. What did I? Okay. So if you buy Johnson & Johnson today, your yield would be over 3%. I mean, of course, you have to get super lucky that you would time it so well, which is possible. I think Simply Wall Street may be easy to read. What's up, Godskin? Okay. 661, 186. So yeah, so if you bought Johnson & Johnson today, you got a 3% yield, assuming they're going to continue paying the dividend in the future, which you don't know, but based on what they're paying now, it's 3.17%. If you bought it at a bad time at the high, it's 2.5%, which is not terrible. But if you got it at their low, it's 72%. So it's like, when you have some time, I would like to get, oh yeah, MPW. Quags, what's up? It's a good one to look at. It's a risky one. It's kind of like It's hard to know, right? It's hard to really. But Meta went up 500%. So why can't MPW go up like that? Meta got so low, but it's so hard. It's scary when it gets that low. It's hard to put a lot of money into it. Like in hindsight, I'm like, oh, I should have just put everything. I should have sold my house and put it all into Meta. But when a stock gets real low, it's hard to get the guts to put a lot of money into it. It's good if you can, but so that's why yield is so dependent on like where you bought it at. But just because if you bought Johnson & Johnson for $6 and you're getting a 72% yield each year, which is a good yield, but you don't have to hold on to it, because if there's a better investment out there. But it's pretty sweet when you're yielding 100% each year. Yeah, so I wanted to go through the should I look at CVS's earnings or ET's earnings? It's yield cost. I have 14% on PayPoint as I bought at a lower price. If you bought today, 7%. Yeah, that's good. 14. AT&T. What would be a really? I was trying to look at something that would have an extremely high yield. AT&T 12 cents, $12. But shouldn't there be stocks like a fraction of a penny when you take into account stock splits? I don't know why. Because 60 cents, even for Microsoft, I thought it'd be like, like a penny. Because of the stock splits. Yeah, I think CVS is a good one. Yes, I think CVS is just brick and mortar retail is such a rough industry, and they're really struggling. It's so hard, especially like you hear things like people, like there's so much theft. People just walk into these stores and just steal things, and nobody does anything. They just let them walk out. It's so frustrating, right? That you have to work hard to buy things, and then when you go to these stores, you have to pay more money. Because how do you think, like, if a lot of stuff gets stolen from a business, they have to pass that on to the consumer, right? That's the only way to do it. So anytime expenses go up, whether it's taxes or it costs more money to buy products, the store has to pass on the cost to you, so you have to pay more money. So ET had good earnings, but when the stock I don't think actually it didn't go up, the stock, right? I don't think the stock moved at all this week from their earnings. Let's do 3 months out. Yeah, so today's 510. So it went up like, I think 1% in the past week. So this is a good example of like, why does the stock go up with bad earnings and go down with good earnings? This is pretty much the reason. I mean, it's not 100% of the reason, but 90% of the time, this is the reason stocks go up with good earnings and go down with bad earnings. Wait, stocks go up with bad earnings. One Q projection. Let's just do so it's not confusing. So say the market is projecting a company's first quarter earnings to be 10 billion. Let's just, all the numbers are going to be in billions, just to make it easy. So that's the market. That's what the market thinks. And how would you rate BP, Scott? How does the market know this? Like, it pretty much every quarter the company says we project the following quarter's revenue to be X. So it's not like the market like has a crystal ball. Like the company tells them, and sometimes it moves up or down depending on things that happen throughout the quarter. But so the first quarter projection for revenue is 10 billion. And let's say their actual revenue is 9 billion. Stock change. So it went down, right? They didn't hit their target, but the stock goes up. It increases 10%. I'm just giving kind of like a hypothetical. Okay. And let's say another company with the same exact projection, they also happen to be a $10 billion revenue projection. And when they report, revenue for company A, revenue for company B. And when they report their results, they beat revenue. So they beat the projection, the forecast, what everybody was expecting. And the stock goes down 10%. Now, why does this happen? I know Victor knows. I think you said that. I mean, there could be 100 reasons, but 90% of the time, or maybe even more, the reason it acts the opposite is because of the forecast. And this happened with ET. So you see, Energy Transfer now expects full year adjusted EBITDA to be 15 to 15.3 billion. So they just released their first quarter earnings results, and companies release their earnings usually 6 weeks after the earnings ends. So 3/31 is when it closed, because they're reporting 1/1 to 3/31 earnings. So 6 weeks after 3/31 is mid-May. So this is around the time, throughout May will be companies reporting their earnings. So last quarter, when they reported their full year through December 31st, 2023, they said adjusted EBITDA 14.5 to 14.8. But they changed it. It changes usually every quarter, whether it's up or down. Now it's so pretty much this is the reason. If they fell short, like in this case, revenue company A, they actually only had 9 billion of revenue, even though they said 10 billion, but the stock goes up, is because maybe the second quarter projection, or their 2024 projection is better. They adjust up. Does that make sense? You lost the audio again? Can you guys hear me or no? I don't. Okay, it's working. Okay, yeah, it should be working. It looks good. So let's say for company A, okay, they always provide forecasts. So at the end of December, on 12/31/2023, they said we project. I'm just using revenue as the marker, but it could be anything. It could be earnings. Okay. They said, okay, we project 2024 revenue to be 50 billion. That was at the end of 2023. And now they just reported first quarter earnings, which they missed. They totally whiffed. But they said, we're actually changing it. We're adjusting it up. So we said 50 initially. Now we think it'll be closer to 60. So that this is pretty much why, 90% of the time. Because when you do your, like, you know how I do my DCF calculations, I'm trying to use the forecast based on what the company thinks will happen in the future. So my model had 50 billion for all of 2024. I mean, the analysts, this is what they have. They have these models, DCF models. So they had 50 billion for 2024. Like they'll have a DCF. And then they have, 2024, 2025, 2026. And then they just have these numbers in there. And it's usually based off of the company's, what the company projects, or they do their own due diligence. So they have these numbers in 2024 revenue, 45 billion, 50 billion. And then, obviously this is not stock price. I'm just making up calculations. Oh boy, it's taking a long time. Okay. Wait. I-107. This is not a real model. I'm just making this up for this this scenario. Okay. Okay. This actually. Okay. Okay. So if I'm an analyst, I work at Jefferies. I'm an analyst at Jefferies. I cover company A, DCF, company A. So my job is to track company A. Okay, so initially I had in my model 45 billion of revenue for 2024, 50 billion for 2025, and 54 billion for 2026. So how did I come up with these numbers? Well, let me just change this. Okay, So the reason I had 45 billion in 2024 is because at the end of 2023, Company A said we should hit 45 billion of revenue for 2024. That's our forecast. So that's how I got 45. And let's say companies don't have to give any information like that. They're not required, but they did. Some companies may give more information. They say 2025, 2026, but most companies just give the following quarter and the following year. And then based on my analysis and based on, I look at other companies, I try to figure out what will be their 2025 revenue, what will be their 2026 revenue. So I just did a 10% growth based on what I uncovered. So I think their 2025 revenue will be 50 billion, which is 10% more than 2024, which they provided me, right? And then I think 2026 will be 10% more than 2025, 54 billion. And I just made this up. I said their stock price will be 20% of 2024 revenue plus 20% of 2025 plus 20% of 2026. Say this is my crude model to come up with company A's stock price. So I tell the world as a Jefferies analyst, my target for company A is 29.79. And then they might be trading at 22 or 32. It doesn't matter, but that's my target. And then company A releases their first quarter earnings and they revise this 45 to 55. So what do? I have to change my model, right? And you see, it went from, so at the end of in mid-February when they released their fourth quarter earnings, I had my model set and I wrote an article about why I think their stock price will be 29.79, and I'm basing it off of my model, which no one can see except me and my boss. And then just last week they changed the 45 to 55. So all I do is just change my model, and then I write a new article out to the world saying I changed my forecast for company A. Now it's 36.41. So that's pretty much what happens. That it's as simple as that. And that's why when is that clear? Does that make sense? I think that's the most simple way I could kind of explain how it works in investment banking. How sell side analysts value companies. They just have these DCF models, and they're usually garbage models, but they came up with it based on whatever they thought. And it's just a lot of their opinions on the company. And then the model gets updated every time they come out with new numbers. That's why NVIDIA kept getting revised up. Like people were saying, oh, NVIDIA is $100 a share. And then next quarter, oh, they're $150 a share. Then next quarter, they're $300 a share. Then they're $500. Why couldn't they just say $1,000 a share in the first place? Why do you have to wait 2 years to say it? Because every single quarter, NVIDIA was knocking out of the ballpark. So let's just say, and let's just pretend this is NVIDIA. Of course, these numbers are kind of meaningless, but I'm just trying to. And I don't think these numbers actually match NVIDIA. I'm just giving you an example. So after their 2Q earnings results, 2Q it ends June 30th, 2023. So mid-August, they tell everybody, NVIDIA tells the world their results, and say they said, okay, revenue 500, So the analyst comes out with a paper and saying, okay, 331, that's what we think NVIDIA stock price should be. So what if it's trading at 200 and people like, oh, 331? Then people start buying, the stock goes up. Next quarter, NVIDIA revises up again. They're like, oh, it should be 700. Let's do 800. So now your analyst goes, okay, oh, we're revising our target up again to 500 from 300. And then NVIDIA, they just keep crushing it every single earnings. So this analyst is now up to 800. And it's not the analyst's fault. It's not like, that's what you think. A lot of people think, well, why every quarter they keep changing their predictions? Like, are they so bad that they couldn't figure it out in the second quarter of 2023? Like, if they were really good, why couldn't they just say 800 here? Why do they have to wait to say it down here? Because the information kept changing. I mean, that was a lot to take in, but does anybody, and it is exactly the same thing with company B, except the opposite happened. Did 11 billion, but the stock goes down, and it went down because of their projection on the future. They revised down. So that's pretty much the reason. Or you could be like or you can be like really good at spinning stories like Elon Musk, and you can like totally tank on earnings, but then just come up with a story that, oh, we're getting closer. Autonomous cars are really close. We think by next year we're going to be in China using autonomous cars. So even though they whiffed on earnings, people start buying the stock because, oh my God, Tesla's going to finally going to have autonomous taxis, and they're going to be able to take over the taxi industry without even having to pay anybody, because autonomous cars, you don't have to pay someone to drive the car. No one's commenting, so was it helpful, or was that confusing? Okay, so we'll go back to ET. So yeah, so they had their record volume, because ET, what they do is they transport oil and other oil-related products through their pipeline. That's really their CVS. Well, CVS seems really undervalued, extremely undervalued, and I had it like $200 a share on my model, but I couldn't do it $200 a share. Okay, Bo, thanks for saying that. Because I always get like kind of like paranoid and anxious, like when no one responds. So, well, I'll show you the. So CVS is trading at 56, and my target was 131. I thought I lowered the target. I can't remember what I did. Maybe I didn't lower the target. I thought I lowered their target. CVS. Wow, it really changed. So just goes to show you. You see, in 2026, the forecast, free cash flow forecast, was 11.7 billion. You see that, 11.7. My forecast is 12.2, because I did my model. I started like compiling my Excel model, my DCF, a week before CVS reported their first quarter earnings. So I was using numbers. The forecast came down. So actually, my model should have come down too. So I should have been more like at 110 instead of 130. Maybe I thought I did something. Okay, I think I might have raised the WACC. That's what I did. Because the WACC, the discount rate. Oh, you see, okay, so the WACC I should have used was 8.5%, or maybe 9.3 to be a little conservative. So actually, if I did my normal model, I probably would have been closer to 160 for CVS. But I artificially raised the WACC just because I don't want to I want to be somewhat in the ballpark. But like it's all opinion. Like the same thing with the Jefferies analyst. It's just his model. Him and his boss came up with. It's just their opinion, which doesn't mean anything. ET, yeah. Well, yeah, ET. You have to pay ordinary income tax on the dividends. So that is a good point. That's something to build into your analysis when you look at stocks. So, I mean, the yield is a yield. Doesn't matter how much you pay in taxes, unless you calculate an after-tax yield, which you probably should do, which most people don't. But yeah, so I received a 32% dividend in 2 years since I owned a stock. But if it was a regular stock and I received the same yield, I would have kept more cash because I would have paid less taxes. Because most stocks, like regular stocks, you pay your long-term capital gains. So it could be as low as like 10% or 20%, depending on your tax bracket. But if you get dividends on a REIT or MLP, or you get dividends, or if you sell the stock right away, you don't keep it for that long, then you have to pay ordinary. I don't want to calculate, because I know if I calculate the difference between ordinary and long-term capital gains, half the people will leave, because every time I go on over these tangents, I could do that. I could show you the difference. But it's kind of like anytime you see a dividend for like an MLP or REIT, I would just knock off 1 or 2%. So if you see a REIT at 6%, if they're a 6% dividend, I would say that's equivalent to like 5% on a regular stock. Like if you bought a tech company and they offered 5%, these two are equivalent. It doesn't make a difference which one you choose, because you get the same money after taxes. But if they're both paying 6%, obviously the tech stock is much better. or if the REIT was paying like 9% and the tech stock 6%, then the REIT is better. I'm not taking into account the likelihood of dividends getting paid in the future. I'm just doing it based on the current dividend yield and current taxes. But if you do buy a stock with a really high yield, you need to think about what's the probability of them actually being able to pay that yield next year. Because anytime you invest in a stock with a double-digit yield, especially like a 20-30% yield, it's a waste. Almost every time the stock will either crash or they're going to cut their dividend. So it's usually just a waste of money. If it was that easy, then everybody would just pour their money into that yield, that stock. And you probably shouldn't own MLPs in a retirement account. Because there's something called UBTI. I think unrealized business taxable income. Is that it? I'm probably saying it wrong. No, I think I'm saying it wrong. Unrelated business taxable income. Who wants to start a hedge fund with me? I'm starting to learn a lot about real estate development. Maybe by next year I'll be able to, if you guys want to be my partners in a hedge fund. This is kind of an odd quirk with MLPs. If you earn $1,000, Victor, me and you, that's all we need. We can do it. We should talk about it more. I can talk about it in the live stream because I'm learning so much. Haven't been in this company just less than a month, and I'm like didn't realize like how connected it is. It's like a hedge fund the way it works. It's really interesting. Okay, if you earn $1,000 in dividends in a calendar year, 1,000 or more. This is good for me to say this stuff because then I remember it better. Assuming this is only in a retirement account. If it was just in a regular brokerage account and you earn 1,000 in dividends, you would just pay taxes like any other investment. It's just higher taxes, ordinary income taxes. But if it's in a Roth, and you earn $1,000, it's subject to immediate taxation, even though it's in a Roth. So you have to pay the taxes on it immediately, which is if it's $1,000, it's not like it's that big of a deal. You have to pay an extra $300, whatever it is, $400 to the IRS. But what if you own like $100,000, like a lot of, like you bought ET at a really low price for like 20,000. Now you have 100,000 of ET stock in your Roth or a 401k, and you got like 20,000 of taxes. 20,000 of dividends. You have to pay, and say you're at 35%. You have to pay $7,000 in additional taxes to the government. And you can't sell the ET stock because it's in a retirement account. You could sell it and get slammed with penalties, but that's crazy to sell something out of a retirement account before you're 65. Does that make sense? So, it's not like you pay the taxes now, so it's not like that bad, I guess. But it's you can't use this like Elon had to pay like $1 billion in taxes or whatever. So he just sold some of his stock to help pay the taxes because it's hard to come up with the money. Sometimes you just have to sell part of your investment. just to pay the taxes. Yeah, Victor, we'll talk about it more. The hedge fund. You're into real estate too, so you probably know more than me on this. But I really have to learn more about like the process. I've learned very little, just the basics so far. Been there 3 weeks, so after a year, I'll understand a lot better. Anybody ever hear? There's a franchise I was thinking of a really good franchise. I really like the business model. It's called Stretch Lab. I went there today. I liked it a lot. They just stretch you. It's great because everybody can use it, especially older people. Like as I'm getting older, not that I am so much tighter than I was when I was younger, but it's just I don't work out it like I used to. Like when I was younger, I can like work out for hours. I could like stretch. I could run. Now I'm like, it's just so much harder to work out when you get older and to stay in shape. I still do it, but it's just so much more work. You're so much more tired. You have less energy. Which is crazy because I never thought I'd be that way. Because in my 20s, I had just so much energy. I could work out for 2 hours. I used to run a lot. Even in my 30s, I was okay. But every decade, it just gets so much more difficult. So yeah, all they do is stretch you. I don't know if that is a good opportunity to work with, because it reminded me, not that I ever got physical therapy before, but it reminded me of physical therapy, what they were doing. Like probably the same thing. You have to get like doctor approval. Because there's liability at this place. They're not doctors. So if you had like an autoimmune disease or if you had an injury, you have to get approval from a doctor, and you also sign liability waiver because you can get really injured if you don't tell them like what you have. You could get injured even if you're in great shape. There's risk there. So but they did a great job. They were really good. It's not cheap though. It's I think it's like, yeah, that's it. My lower back too, from sitting all day, and my neck has always bothered me. So I'm just hoping. But it was like, I think it's like $70 for an hour, which I get it because they have to pay somebody to do it. Like it's not like you can have, like in my tutoring center, I could have 5 kids with each instructor. So, but here you have every time there's someone that goes to get stretched, you have to have somebody doing it. It's a one-on-one thing, so it's going to be more expensive. If it was a classroom thing with 20 people and one instructor, then it could be real cheap, like $20, $30 an hour. But yeah, physical therapy, there you go. It's probably covered through health insurance. And this is not covered through health insurance. I imagine if you have flexible spending, you probably can use it towards flexible spending. But it's definitely not covered by insurance. I don't think so. Actually, I'm not sure, to tell you the truth. But yeah, I wanna look into the franchises. I do like it a lot, but I'm not a big fan of the one-on-one because it's really hard to scale and become really profitable because finding people is not easy. Because you can't pay them like that much money. Like maybe the most 30. I mean, even if you were paying 30, I don't think they're probably paying, I would think they're probably paying like 20 an hour. So it's hard to find people willing to work. You have to find in like college students or stay-at-home moms. Yeah, that's the only thing I don't like. It's kind of like the Uber business model. As great as the company is, it's hard to make money when every time you make a sale, you need an employee, you need somebody on your staff there every single time you make a transaction. That's why, like, selling ad space, like Meta, it's very scalable, make a lot of money, but it's a good business for like an individual or a couple to have their own business. It may not be the great for an investment. You know, if they were trading on the New York Stock Exchange, it probably wouldn't do that well. But I guess if you scale enough and if you have 20 centers and you make 20,000, 30,000 each, I guess you can possibly never used a chiropractor. I know they are controversial. I used to go to a chiropractor. I'm doing acupuncture this coming week on Tuesday, which is really expensive. That works. That's like really good acupuncture. Actually, I'll be right back. 2 minutes. CVS. Actually, we were talking about hedge funds. Do you guys want to know how hedge funds make money? Okay. So assets under management. So it's you might have 10 people investing in your hedge fund or 100 people investing in your hedge fund. So how much money you invest for all your clients. So there are hedge funds with, generally they're not, what's it called? Not BlackRock. What's that company that's always BlackRock, right? BlackRock. Yeah. You're not going to have a hedge fund generally with $1 trillion of assets under management. What are those? It's always on Simply Wall Street. They're always there, the same two companies, Vanguard and BlackRock. Those are the two biggest asset managers in the world. They both have close to 10 trillion, 7 trillion for Vanguard. BlackRock is 9 trillion. Schwab is 7 trillion. I didn't realize it's so much. Now, I'm not saying physical therapy is not a good business. I'm saying one-on-one businesses that you need an employee. Every time you make a sale, you need an employee to do the sale. Those aren't good businesses generally. Not that there are a lot of bad businesses, or like if you own a clothing store, you don't need a person every sale. There could be 20 people in the store, then you have a cashier and 3 salespeople on the floor. Some people just walk into the clothing store, pick a few things out, and buy it and leave. So you can have 20 customers with 4 employees. It doesn't have to be a one-on-one experience. So that's much, you can see how it's more scalable. But if you have a I guess we'll do the physical therapy thing. Physical therapist, you can have like a room of 6 people who need help, and then you tell everybody to do the same exact thing. It's kind of like a personalized experience. But it's a doctor too. Doctors are a one-on-one kind of experience. But doctors charge like so much money per visit, and sometimes doctors charge a lot of money without doing anything. So it's hard to scale and grow, especially when your customers are not paying that much per session. You can't charge like $1,000 for an hour of physical therapy. If you're like a private business, you charge like $80, $120, $130. But you have to pay the employee to be there. That's all I meant. Okay, say you're a hedge fund and you manage money for your clients, and you have $1 billion and that could be across 50 people or 200 people investing. Could be all friends and family, some hedge funds. But if you're $1 billion, it's probably more than just friends and family. So it's most of them do 20%. They say 2 and 20. It's a total scam. It's such a ripoff. 2% and 20. Okay, so let's just say on January 1st, there's $1 billion of assets under management. And just assume that on January 1st, I had $1 billion and nobody added any money to the fund in 2023, and nobody took any money out. Because if that happens, it gets a little harder to show you. But this is really simple way to do it. So the fund made $200 million for its clients over the course of a year. So they charge, most of them charge this way. Some are different, but most of them charge 2% of assets under management and 20% of profits. So income. So the income for this hedge fund would be $60 million. So you charge 2% of assets under management, a flat 2%, and then you charge 20% of profits. So they made 60 million for the year. That could be, they could have 30 employees or 5 employees. I don't know. So you have to make money, because if okay, because say what if people lost money, which happens for the year. There was $1 billion of assets under management, and then when the year ended, 900 million. So they make nothing on the 20%, because they only get 20% of profits and 2% of assets under management. So they made $20 million for the year. But I thought it was 2% and the first 20% made. The rate changed after 20% is made, I think. I don't honestly, I should. It's pretty much like an ETF. So the thing is, they're incentivized to give you a great return. So they're more likely to take, swing for the fences, so to speak. So they probably, they'd be happy with a 10% profit for the year, but they really would like to get a 50, 60% profit, because the more money they make, the more they make. And that 20% is where they really make the money. So they get paid regardless. Even if you lose money, they still get 2% to pay their operating expenses. But the 20% is like the bonus pool. So if they have a really good year, like it went from 1 billion to 1.1 billion, they got 20 million to pay their operating expenses, which is just the basics, the payroll, thing like that. And the 20% is their bonus for the year. And they don't take the investment risk, since it's their client's capital. Well, no company really takes the investment risk, right? Whether it's a mutual fund, a hedge fund, or it's always other people's money. You're just investing it. I guess some people who own a company, if you own a company, I guess there's some risk, because you have to pay your expenses and you want to have a reputable business. It's a waste. It's such a waste. And they usually don't beat the market. Most don't beat the market. So it's such a waste. It's like you don't get any value. What do you mean so this could be 2023. Yeah, I used to pay a financial advisor too. I don't know why. I just thought for some reason. What the hell's going on? Damn, I'm so stupid. G. Come on. This is why it's a total racket, because say in 2023, their portfolio went up 100 million, went from 1 billion to 1.1 billion. So they improved their clients 100 million. And all the clients share in the profits. So if I make 10%, you make 10% on a hedge fund. It's not like it's not like my investment with the hedge fund made 20%, yours made 10%. We all share the same exact portfolio. We don't have like when you go to like E-Trade or and you have your stocks in your retirement account, it goes up and down based on those stocks. It has nothing to do with other people's portfolios. Yeah, and so in 2023, they made 100 million. So they had $40 million of income, 20 million from the 2% fee, and 20 million because they get 20% of all profits. Then in 2024, they made only 22 million because they get 2% of assets under management, nothing because the portfolio went down. So they only 22 million. Then the following year, 2025, the portfolio started at 1 billion, went up to 1.1 billion. So they got their 40 million again. So they didn't make any money. I mean, not that they didn't make any money, but they're still at the 1.1 billion, which they were at the end of 2023. The same exact spot. I mean, to make it even worse, and I'll show you, this is even worse. So if they had $1 billion of their clients' money, it went up to 1.1 billion. This is their income. Then the following year, it was a really bad year. It went from 1.1 billion to 900 million. So they lost 200 million. So they only get 22 million for the 2%. They don't get any bonus. The following year, they added 100 million. So they didn't even add any value. They started with $1 billion. 2 years later, they ended with $1 billion. But the hedge fund made $100 million in fees. So the hedge fund is the only one that made money in this case. A whole life insurance. There's nothing wrong with it. It's just another type of investment. I don't think it's a terrible investment. The fees tend to be a little high. That's the only thing I would say. But I know the idea is for the hedge fund to make a lot of money for their clients. So the hedge fund makes money and the clients make money. That's the goal. But we know one thing is a fact, is the hedge fund will never lose money. They may break even some years, like in this year, but they're always going to make money in the long run. Even if you don't make any money, they're going to at least break even, possibly make good money, which they did. Because 2 years, they got their bonus, and you didn't really end up any better. The higher the fee, the better the hedge fund. So there was a hedge fund that took 100% fee. I never made any money, but they made a ton of money. And that's all that counts. And I've worked at hedge funds, and they do have different structures. Like, it's not all 220. I would say probably like 80% hedge funds use the 220 thing, but See, the fee is typically 2% of funds over a 12-month period. I mean, technically, they take the 2% fee on a monthly basis. So I don't know. It depends. Assets under management each month they do it. But I just made it easy. I just did an annual. And then so they get a 2% of assets under management, and then a performance fee, a reward for positive returns. Performance fees are typically 20% of profits. But I've seen hedge funds structure it differently. But it gets really confusing when they try to change the fees. But it's ridiculous. I guess 2 and 20 is really the number one. But if you have a regular investment advisor, like at Morgan Stanley or Schwab, they're just going to take the 2%, and that's it. Whether you make money or lose money, they take that 2%. Some of them do 1%, some of them do 3%, but it's about 3% on average. So you're paying 2% for their advice. So they need to beat the market by 2% for you to break even. Because you could just invest in the S&P 500 and get, say it averages 10% over the past 20 years. So you can just get your 10% S&P. So you have to get 12% from the financial advisor, and they don't even get to they never even hit 10%, let alone 12%. They usually get like, I don't know what they get. So okay, Matt, I've seen some charge really low, like 1%. A typical independent financial advisor, 25 basis points to 100, but some advisors may charge. Okay, actually, I think their average is actually 1.5%, not 2%, for a regular financial advisor. But I've seen it up to 2%. It's just such a waste of money. But I totally get it. It's kind of like I pay someone to work out with me. Like every Saturday and Sunday, my wife and I do over Zoom. This guy we've known for a long time, a personal trainer. Why do I pay somebody? I could just do it. It's motivation. So I totally get it when people don't feel comfortable. They may not make the right decisions, so they rather just pay somebody. I'd rather be hands-on. I don't have any schooling experience. You guys, I didn't learn anything in school, Quags. So it's not a school thing. I've learned much more from doing it. School, you don't learn anything. But that's why I say, if you don't know anything about investing, and people who don't know anything about investing, they're like, I'm so confused, I don't know where to go. I just say, I'll show you. It takes me 5 minutes. All you got to do is open a brokerage account. If they can figure that out, that's a big step for a lot of people. And I said, you go to the button. This button, it's called buy. You type in the ticker SPY and you buy. Anytime you have money, that's all you buy. And that's it. That's the end of it. But most people won't do it. They think, oh no, it can't be. It has to be a lot more complicated than that. I'm never going to make money that way. I learn a lot by losing. A lot. I must have lost $1 million, but I've made it, maybe not 1 million, but a loss is something when you sell the stock at a loss. Not if you count all your down days, it doesn't matter. So if I count just when I sold the stock or sold my investment, I'd probably say 200,000. I probably lost 200,000, but that includes my real estate, which I lost like 70,000 on that. But there's a few stocks, like ASAP, Waiter. That was my worst. I lost, I think, 60,000 on Waiter. I'm already down 30,000 on Accelera. But just one investment. Berkshire, I'm up over 400,000 on Berkshire. So that already made up for all my losses. But in other stock, there's other investments too that my best investment was the franchise I bought in terms of profits and return. Of course, that was a lot of work. It wasn't just I did buy Meta. If it falls below 400, I probably would add to it. I don't think I'm going to add. I just have so much in it. I didn't write it down. I bought it a few months ago, but I think I got it at like 480. So I think I'm down on that one. Well, maybe I'm even on that one. So it peaked at 511. When it hit 511, I saw it coming down. I think I got it around 480. I didn't see it coming down to here, but it's coming back. It'll come back. By the end of the year, it's going to be 550. Jimmy John. I guess the more I'm talking about Stretch Lab, the less I like it about it. But I'm going to talk. The Stretch Lab I went to today, they own 2 Stretch Labs in my town. So and they weren't there today, but they are there sometimes. So I'm going to try to talk to them and learn a little more about it. So that's a good model, fast food. And brick and mortar isn't the greatest model, brick and mortar, but it's a lot easier to get sales when you have a physical storefront. Because when you have a website, it's just almost impossible for people to find you. But if you have a physical storefront, it's a lot easier. People trust you if they see you. When you're online, it's hard to get in front of people, and it's hard to convince people you're a real, company, not a scam. Who owns Jimmy John's? I remember they are part of another company. Rourke Capital, yes. Private equity. I sold my McDonald's stock. That's a good stock. That's a good franchise going, right? McDonald's. The real estate development company I'm at, they bought 6 Habit Burgers. We're developing the land, and then we're going to put the Habit Burgers there. So private equity, they buy up a lot of these businesses. So it's like a hedge fund, because if you own if you were running this hedge fund, you would invest in stocks, right? Most hedge funds is stocks. And so you hope the stocks go up and you sell at a profit, or you hold on to it and collect dividends, whatever it is. But some hedge funds or private equity, which is similar, they buy businesses. So instead of buying stocks, they buy private businesses. I mean, Berkshire bought Geico. That's a private company. That's not publicly traded. They have a lot of private companies. And then they hope to run a private company similar to like a stock. They get a return maybe each month or each quarter based on profits. And then maybe down the line, they sell it at a profit. It's not as liquid as a stock, because a stock, everybody knows the price because it's trading, whatever the stock market price is, that's the price of the stock. But for small businesses or private companies, it's really based on like what someone's willing to pay for it, right? There's no like it's not like buying a home. You just compare it to the other homes in the neighborhood, what they sold for, and that's how much your home is worth. They have 1.4 million employees. It's a lot of employees, because the employees are at the companies they acquired. Like they own Anytime Fitness, Cheesecake Factory. So all the employees at all those stores, because at Rourke, at the private equity shop, there's probably like 500 employees, maybe. I don't know. I'm just guessing. But pretty much all their employees are at their subsidiary level, the companies they own. They own a lot of companies. Been hearing Shake Shack for 2 years. Yeah. SILV. Berkshire is not a BDC. Berkshire is just a holding company. Does anybody know what a BDC is? I think it's, I know what it is, but is it Business Development Corp? There's only like 25 BDCs that are actively trading. It's not common, but they usually invest in small, kind of struggling businesses. They don't invest in like Apple, like Berkshire. They don't invest in public companies. They invest in like usually struggling small companies. Like maybe if somebody owns say somebody owns they don't own a Cheesecake Factory, but they own a business that's similar to Cheesecake Factory, but they just have 6 of those businesses. It's called like Jim's, Jim's restaurant. So they'll invest in like something like that. But it's an interesting investment. I think they're pretty risky. I don't think I would invest in it. Business development company. Business development company, not corp. What did I say? A company. Okay, and invest in small and medium-sized companies. Yeah, as well as distressed companies. So they're not all struggling, but they're smaller in scale. They help like these small companies grow by injecting capital into them. So BDCs are public entities, but the companies they own are all private. I believe. A business is a type of close that makes investments in developing financially stressed companies. BDCs are publicly traded, open to retailers. BDCs offer investors high yields, and some capital BDCs heavy use of leverage. Use Congress. Yeah, I'm pretty sure every company a BDC owns is a private company, not a public company. Yeah, so BDCs invest in private companies and small cap. They do invest in small. Okay, so they invest in small public and private companies. And sometimes companies that are struggling. But they own like 1,000 companies. So even if 10, 20 go out of business, it's not that bad, I guess. But I wouldn't invest in them, but it's interesting. Yeah, so Berkshire is just a holding company. It's kind of like a mutual fund or a ETF, Berkshire. It's kind of like in that category. But a mutual fund and ETF own public companies, not private companies. So they own public and private. But they're just considered a holding company. That's their term. That's their, like, if you were to compare them like a REIT, a BDC, an MLP, I would just say Berkshire is a holding company. There's no he's getting up there. I had a hard time like focusing when I like listening to him this year. Like it was not as easy. It seemed like he's just getting up there in age. It's definitely the largest holding company in the world. Okay. Yeah, it's a holding company headquartered. I guess that's the best way to describe it. There's a lot of holding companies that trade in the market. So the purpose of a holding company is they hold stock for other companies. So a holding company does not produce goods or services itself. So they don't do anything. That's why they only have like, I think 5 or 6 people that work at Berkshire Hathaway, which is pretty amazing. But so its purpose is to own stock of other companies and to form a holding company are created to hold assets such as intellectual property or trade secrets that are protected from the operating company. Okay, that's it. So not all holding companies are like Berkshire, where they just own other companies. Like you see this, holding companies are created to hold assets such as intellectual property or trade secrets that are protected from the operating company. So it's just to kind of separate that company for litigation. Like you might have a company, Coca-Cola, that sells, they sell soda, but they mostly sell the recipe, the syrup to make the soda. They sell it to bottlers. But there's another company that just holds the recipe for the Coca-Cola recipe. So it's kind of separated from the operating company. In case somebody sues Coca-Cola, they can't get access to that intellectual property, which is the average age. Yeah, it must be, right? Well, it came down a lot because Munger died. He was the oldest. I just know Greg, Abel, and Warren. Oh, I know Jane. His last name's Jane, the guy who runs the insurance part. I can't remember his first name, but well, they don't work. These are like his family. A G chain. The Quags, thanks for the donation. Appreciate it. TKO versus EDR. No, we could look at it today. What else do we have to do? TKO. Technical knockout. That's the thing. There's so many companies, and some companies are just holding companies, so they don't do anything except hold stock in other companies. But it just adds to the number of. It's kind of like a derivative. You know what a derivative is? It's just its value is derived from something else. So you can have like. You could have like 100 companies in the world that do things, but then 100 operating companies, but then you have another 100 that just own pieces of those 100 companies. So kind of like, it seems odd, but and that EDR pays a dividend, but the other one doesn't. So you can see EDR has 10,000 employees, but TKO has no employees. This must be the operating. I mean the holding company, TKO. I think. Um, if you want to compare companies or compare anything, revenue is a good one, because sometimes, like, if you look at it at Yahoo Finance, sometimes the net income doesn't match the company's numbers, and sometimes the cash flow is different from the financials. So, but revenue is always the same. Does anybody know that these two, TKO and UFC, had to pay settlement in there that hit their balance sheet? Both WWE and UFC operate as divisions under TKO. So the subsidiary is created a part of the merger between and Zuffa. Okay, so Zuffa is not around anymore. That's so it's just a holding company for those two. The merger marked the first time that WWE has not been solely and primarily majority controlled by McMahon family. So Endeavor, the company was founded in 2009 at the merger of William Morris and Endeavor. Endeavor represents artists. It also represents the NFL and NHL. Endeavor owns professional bull riders and is the majority owner of WWE. C30. Okay, so Also, they're both holding companies. So Endeavor owns a lot more businesses. I guess that's why Endeavor's revenue is so much higher than TKO, because Endeavor owns all these other businesses in addition to WWE and UFC. The group additionally owns 20% stake in the 5th season Why are they separate? Well, they have different companies beneath them. They have different assets, I guess. It is kind of confusing, but they own. So Endeavor owns 2% of TKO. No, I don't think it's brand. I think it's just they're just different entities. They have different assets. It's like if we both own Apple, I mean, we have our separate portfolios of. Endeavor. Right. TKO owns 2 companies. Well, they may own other smaller ones, but okay, here's their assets: WWE and UFC. So they just own 2 companies. They own 100% of these 2 companies. I think 100%. Endeavor owns 2% of TKO, and they also own many other companies. They own Professional Bull Riders. They have and all these other. They own 20% of 5th season. Which this is confusing me a little bit because it says what was I looking at? Oh, no. But now here it says it has a 51% stake in TKO, which so I don't know why Simply Wall Street says 2%. 2% right here. Or maybe they own. Maybe simply Wall Street's wrong, or maybe they own like preferred stock or something like that. Maybe the 2% is like a different series. Like, you know, there's series A, B, and C. Maybe series like B, but that's only for voting shares. I don't know. How would I find out? What other websites show you how much a company who owns the company? What websites provide like a breakdown of Endeavor, Refresh Endeavor. It's mentioned a lot in here. Endeavor. Okay, well, it says it right here, so I guess it's true. Oh, they do. It's voting. Okay, that makes sense. So they own 51% of the voting shares, not 50. Yeah, it's the Class B shares. Class B shares have more voting rights than Class A shares, so they own 51% of the voting power. It's interesting. Okay, so the owners of the company are made up of 82 million Class A shares and 89 million Class B shares, and each share gets one vote. I thought it was going to be 49.51. So each share gets one vote. So whoever owns the B shares owns 52% of the voting power. So are you still confused? I mean, yeah, the reason companies offer B shares or sometimes C shares is so the owners of the company have voting power. So no one can like take the company over because they have all the voting control. But the Class B shares aren't worth anything. They just have one vote each. So, okay, so 52.1, that's what I came up with, 52.1. So Endeavor controls 52.1%. Endeavor owns 100% of Class B, which gives them 52% voting power in the company. Why does it say 89 million under Class A? Each takeout operating company unit is redeemable from time to time. Well, yeah. So Class B, if you own Class B, you're not getting any dividends. You can't sell it for anything. It's just to maintain voting control of the company. Because I bet you the shares outstanding should be 89. No, 82. 82,321. So the shares, implied is the best way because the math always gets screwy with it. So implied shares outstanding is 82.32 million, which are just the Class A shares. Those are only people whose stock is worth anything. So if you own a Class A share, you have $100 of stock. Your assets worth $100. And Class B shares are stock isn't worth anything. I'm not even sure what was the purpose of this? To see the difference between the two companies. But their market cap is so similar, it's almost identical. That must just be a coincidence. Because they're different companies. They have very little in common besides the same people. But the assets are totally different. It's just a major coincidence their market cap is so similar, because you can see how their stock doesn't move together at all. It did kind of, but then, I guess it was September 2023 was when they. Okay, so they were the same company up until September 2023. Then they separated companies. So now they're trading apart because they're two totally different companies. Which one I would buy? It's hard to say. Well, TKO has WWE and UFC, which are pretty big. Endeavor has a lot of really, besides WWE and UFC, they have a lot of really crappy companies. So I guess I would have to go with TKO because it seems like Endeavor is just investing in professional bull riders. Who the hell cares about that? And then the fifth season, they own 20% of the fifth season. It's an American multinational film and television company. Yeah. I don't know. If you want entertainment exposure, get the best entertainment company in the world, Netflix. The only company that's evolving, that's maintaining customers. It's kind of getting a little pricey, but I'm up about 60% on my Netflix. I wish I just bought more. I wish I averaged down. Because I was yeah, I bought on the way down, but I wish I kept buying. I could have got it for under 200. The roast Tom Grady. That was pretty good. I loved watching the roast. The James Franco roast was really good. That was probably the funniest. It was decent, Tom Brady. Netflix is it is a bit steep, 33 times forward PE. It's a little pricey, not terrible. 33 times. What's Nvidia? Probably similar. $37. Yeah. Berkshire is probably 28 or something. I don't know. 19. That's really good. 19. Okay, where were we? Oh, CVS. It's, a Karen owns CVS. The CEO is a Karen. That's just so. What else would you expect from CVS? There's a bunch of Karens in there. $88 billion in revenue. $88 billion for one quarter. So they're so 30. Okay, so about 1/3 of their revenue is premiums, insurance. See it as a big money making. I don't like a UFC. I see UFC as and a lot of people like that. I don't see bull riding ever making a lot of money. Maybe in other countries. Yeah, CVS. That's a good dividend play. Healthcare is always going up, right? Healthcare is a good so this is a good so their healthcare benefits segment, $32 billion of revenue. It's hard to, and only 1% of operating income. Operating income is only 1% of their revenue. So really bad margins. Health services, $40 billion. operating margin 3%. The pharmacy part, 28 billion, 4% margins. So really, really small margins. I've been accumulating Microsoft. So anytime I had extra money from dividends, I buy Microsoft. It's kind of late to the game, I guess. I just was bothered. I never had any Microsoft. Waste Management's a good company. I like what they do. They're getting pretty big, 85 billion. Do you guys collect baseball cards, or did you ever collect baseball cards or sports cards? I bought a few cards recently just for sentimental reasons. I wish I held on to my cards from when I was younger, because I probably could have made a lot of money. Most of them got thrown away, which is depressing. Waste Management. Look how low it was. You could have got it for $2. It's a long time ago, 1990. It's like almost 35 years ago. Yeah, I'd like to trade cards. I try to get into it more, but I'm just so concerned I'm buying fake stuff. I don't trust a lot of these websites. What really came up a lot in 99. Wow. So it was over 50, and then it came down to the teens. And then from 2000, it went up a bit over the next decade, but it really rose. Yeah, you never know. One day, that's the way to do it. So, it had a great run up. Wow, it really ran up recently. It was 175. No. So it was down to 150. So it's up about 40% in 6 months. I never heard of UFC cards. You see all these baseball cards? I bought a few. eBay, apparently the cards are sent to. I bought a $1,000 bill recently. I always wanted a $1,000 bill. There's a lot of private information here. Yeah, so now I have a $500 bill and a $1,000 bill. Okay, well, I'm getting a little utilities are pretty safe investments, long term. Yeah. Okay, well, until tomorrow, I'm kind of losing steam here. Thanks for joining. I'll try to do a live stream tomorrow. Thanks for commenting, and I'll talk to you later. We have a good core of people. It's a fun. It's always a fun stream. Okay, see ya.